for being here today. This is the Emerging Manager panel. My name is Shelley Rosensweig. I'm a partner and co-head of the investment management practice at Haynes & Boone in New York. Our practice is very broad. We focus on GP and LP work, structuring and designing private investment funds for the GP side, and also helping investors when they are allocating, conducting legal due diligence, and helping them to structure their investments into private investment funds. We have a lot to cover today, so I just want to say that if anyone wants to talk, I will be here for the rest of the conference, and you can also connect with me on LinkedIn, and we will jump right in. I know that the people here have a lot to say, and I want to get started. So the first question that I want to ask is a question that, because all of you have your own unique structures and you are focused on different things, what would you define as an emerging manager? I think the audience would be very interested to hear that. You want to start, Richard?
Sure, yeah. I'll start off just by giving a quick introduction. I'm Richard Macklem, portfolio manager at CPP Investments. And the group I'm a part of is called External Portfolio Management, which allocates to hedge funds. So CPP Investments, we manage the assets of the Canada Pension Plan, about 675 billion now Canadian in assets. And we invest globally across different asset classes. The group I'm a part of, External Portfolio Management, we manage about 10% of the firm's assets, and we focus on hedge funds in public markets. And my specific focus within that is our Emerging Managers program. So what is an emerging manager for us? Really, it's a fairly broad definition. Really, any new launch or recently launched fund, and that could be anywhere from a smaller under-the-radar launch to quite a large name. And really the main objectives of our Emerging Managers program are threefold. One, we're looking to generate returns, obviously. Two, we're looking to secure capacity rights to enable us to scale. And three, we're looking to obtain favorable terms that compensate us for taking on some EM risk. And I'll say, just the last point, our starting ticket sizes are typically 100 to 350 million, and we look to grow from there with our capacity rights. So we want to be scaling and topping up as a long-term investor.
You want to tell us about your definition of emerging manager?
Well, like I said, it's pretty broad. It's any new launch or recent launch.
Okay.
Public markets, and yeah, I'll stop there.
Okay. All right. Enrico?
Shelley. So thank you, everyone. Enrico Massignani, Chief Risk Officer of Abu Dhabi Investment Council. Abu Dhabi Investment Council is a sovereign wealth fund based in Abu Dhabi. It's run with an endowment model, and we do allocate to basically any asset class, mostly equities, a lot of private assets. We don't have a definition of emerging manager. It's more about identifying what part of the life cycle they are, so mostly new. They can be new both in terms of a setup. Maybe they can be new just because they span off other shops, or maybe they may be having a long track record, or they may be new to new asset classes as well. Usually they tend to be small.
Okay.
Great.
John?
Thank you. Yeah. Well, so John Claisse from Albourne, and actually I'm excited to be on this panel because actually just to maybe counter some of the perceptions around consultants only covering large established funds, and because actually obviously a lot of consultants do have a narrower buy list, but we really kind of operate in quite differently, in part just because of the breadth of our client base. And when it comes to the definition of an emerging manager, it really is very different from client to client in terms of what they're really kind of focused on, and a lot of time is focused on the kind of that threshold of how many years they've been in business, or how many, hundreds of millions or billions they have under management. From our perspective, we certainly have some clients where there's a sort of, maybe it's a 250 million kind of threshold for in a private market fund, first or second or third time fund. And then on the hedge fund side, again, it can be family offices looking at 100, $200 million firms, but large sovereign wealth funds looking at kind of groups that could be going into the billions, but it still represents an early stage manager that they are focused on covering. When I would say kind of when you move away from that kind of threshold, also a key point is just where they are in their life cycle. And we do a lot of work on managers in their formation phase, pre-launch, and then once they've actually launched, in terms of doing diligence. We have due diligence on about 10,000 funds and fund series across the universe, and so the reality is a very significant portion of those are emerging managers. And on the private side, between 75 to 80% of the managers we cover are first, second, or third time funds would be emerging managers as one definition. And in particular, so that's probably enough for now. I've got a lot more to say on.
That's very broad. Erik.
Thanks, Dr. John. I'm Erik from Stable. I'll give you just 2 minutes on what we do, and then I'll touch on Shelley's question, how we define an emerging manager. The quick answer is it's a frame of mind. So what do we do at Stable? We back founders of emerging investment firms, and we help them build exceptional businesses. We bring two things to the party. Lots of money, so we typically invest somewhere between 100 and 300 million in their funds, be it a fund one on the private side or day one or early on the public market side. And then we have an operating partner platform where we help them on the operations and the distribution side. So really be institutional, best practice, and attract high quality capital. The real alignment of how we invest is that we become partners in the firms that we set up. So we become minority owners through GP stakes. And this is really beautiful in the sense that the LP-GP relationship is quite misaligned in our view. As they grow, GPs tend to gather assets, they get focused on management fees, then they sell a stake, then they go public. But poor asset owners, they don't participate at all in this. When you look at all the esteemed billionaires here in this conference, their wealth is majority monetizing their GP and not carry. So we think that LPs and asset owners should be participating in that wealth creation as well. So that's our model for emerging managers. And the definition, as I mentioned, is really a state of mind. So if you believe that you could do better with a strategic partner that has made many mistakes over many years, we've funded about 35 businesses. They manage about 18 billion or so altogether. Then having a partner is what makes you an emerging manager in the sense that you know what you don't know, and we're here to help you.
Okay, so there's a lot of different definitions here, and it's pretty broad. So anyone who's sitting in the audience and wants to talk to any one of them after, there's a lot to choose from here. Let's change topics a little bit here. Have you noticed any key trends in the types of strategies or asset classes where emerging managers are either gaining traction or where you are looking to invest? And maybe we'll let Erik start with that one.
Yeah, sure. So I'll touch a bit on public and then private. Absolutely, key winning strategies. Now, on the public side, we're mostly focused on absolute return. So hedge fund managers, we see this either RV, market neutral, factor aware, or there's sort of high net directional. The middle is kind of dying or dead. So you actually have to decorrelate and diversify in that first bucket, or you have to be giving some extra alpha on top of beta exposure. So if you're planning on doing something in public markets, probably pick one of the two sides and not be in the middle when you don't know exactly what you are. On the private side, we're seeing a lot of interest in private credit, so we're spending a lot of time on private credit. Not the more direct lending, vanilla, that's really a scale game for the big firms, but things that are a bit more uncorrelated, niche, anything from royalties to secondaries to asset-backed to structured lending. And then in private equity, pretty sort of specialist strategies. So again, going into things like what we call sort of bootstrap growth, not late venture, not growth, somewhere in the middle, roll-ups, sort of thematic private equity strategies.
Okay. Does anyone else want to take that one too?
Yeah, sure. I mean, so for us, we're really looking at all different hedge fund strategies and all new launches at all times. We have a large and global team, which allows us to do so. We have strategy experts that focus on, different hedge fund strategies, and then, team members across Asia, Europe, and North America as well. So we really focus on building just a diversified portfolio rather than focusing in on any one strategy that might be in favor at that time, as we think it's difficult to time strategy alpha.
I think an interesting phenomenon, probably everybody got noticed, is in the digital asset space. There's new managers, new emerging managers. They're quite small, but let's see, with Trump administration endorsing digital asset space, maybe they are growing asset. And that is quite interesting space to follow also because they pose different challenges, especially on the operational side.
Yep.
Very interesting. The other thing in the private markets is what we have seen during the last years is operators that are becoming GPs. They set up a GP structure. Basically, they're integrating that part of the business. They're changing a bit of business model, still keeping their core operator soul. It's happening very often in the data center space, in the real estate in general, real estate infrastructure, I would say.
Yeah, maybe just to build on that, just the way people are coming to market. A trend that we've seen accelerating in the last year is the kind of, on the hedge fund side, the rise of more and more allocations to SMAs. And often when you're talking about the emerging manager landscape, there's obviously a lot of talk about the platforms, being kind of sort of sucking up a lot of talent and maybe kind of leading to, there has definitely been a slowdown in the number of new launches. So just from that perspective, in the last 12 months, fewer than we were seeing. Sort of the run rate of the last 8 years was in the kind of, on the hedge fund side, 500 to 600, and sort of slowed down over the last couple of years to the sort of 300 to 400 range. And in terms of legitimate launches, that in terms of capital, but we are seeing more firms that are launching, only raising money through SMAs as a shift, and part of that is groups that are trading capital for the platforms, but also taking money on the side. And I do agree, we're just starting to see the very early stages of new fund formation and separate strategies on the digital asset side. Obviously, it's not new in the sense of covering dozens and dozens of funds, particularly on the private side over the last 7 or 8 years. But you can see the kind of, just a pickup now in fund creation there. And another big trend is the sort of beta 1 implementations that Erik mentioned. We're seeing that a lot.
Well, as an attorney who represents a lot of emerging managers, I can just tell you that the last 5 launches that I did, while all of the managers did launch funds, they all had SMAs as a parallel. And they had pretty large allocations, and it was very interesting to see that there was a group of allocators that were willing to place capital from day one, and that they were amenable enough to negotiate into an SMA and lock themselves up for a period of time. So I just thought that was a really interesting feature, because last year I didn't see as many SMAs, and the last 5 launches I did at the end of last year, which are now launching this year, they all contain an SMA component. So I totally agree with that. So now let's talk about what you are actually looking for. What are the primary factors that you each consider when you're either making an allocation or making a recommendation to make an allocation? And that's more focused on the emerging manager side. So Enrico, why don't you take that one?
So I look from an holistic point of view and with risk lenses. And there are 2 elements that you really want to get it right. One is, which is, let's say the simplest, is there an alpha generation engine that can grow? Number 1, sustainably. The other thing is the business. It's incredible how great portfolio managers, great traders eventually got the business angle right. They just underestimate the effort of running a business.
Yes.
So being a CIO is not being a CEO, is not being a CFO. And when you see, for example, that anything beside the investment team is weak, that's tend to be a red flag.
Is that something you immediately focus in on? You immediately look at who's the non-investment team around the portfolio manager?
Yeah, you look how they structure the non-investment team. It doesn't have to be heavy, but you need to have good people.
Solid.
Yeah, strong enough, at least as strong as the funder.
Yeah, and I would just echo that in the sense of you expect a different setup from a 5, 10, 15-person firm coming out the gates. It's absolutely fine to outsource to different service providers that will provide you that operational support early on. But it's a performance business. The investors have to be focused on managing capital and generating, that alpha, the alpha that you're kind of paying for. And so ensuring that out the gates, that the managers are really kind of taking into account the business side of the organization. And I think there's just a lot of support the managers can get from their service providers in that formation. On the hedge fund side, the prime brokerage community do a great job of supporting managers coming out. And I mentioned before, we do a lot of work on funds pre-launch, where we're brought in by investors who are going to seed managers and do the operational due diligence. It's really important differentiation as well, just for people to be aware of what our goal when we're looking at these, an emerging manager. The majority of emerging managers fail, right? So 4,000 launches over the last 8 years, and the majority of them are, more than half of those are out of business now. And so when you look at the IDD, if you do investment due diligence, actually you'll probably end up viewing that as probably a pass for the average fund. But for the ODD, we can come in and do detailed work, and for an investor who's going to put their capital at risk, and then they'll use that to work with the manager and ensure that they eliminate some of these business risks that are present. And so something that we've actually done with emerging managers over the last 5 years is to move to ensure that every firm that we meet with and we gather information from, we make sure we put out a not rated report straight away, with low conviction, just to say, look, this is what they're doing, but rather than rate them, day one, unless we really know the team and we have high conviction, because we actually don't want to impair their ability to raise capital. And so that's been a shift in our kind of perspective of how to engage with early stage managers. Coming back to the point about what are you looking for in startup funds? You're looking for a team that will work well together. But in many cases they are coming back together after, unless it's a kind of clean spin out, after working at different locations for a while. And so there's just a lot of business risk that can come from reforming an investment team. And so that's been a shift in our model to make sure we do get these, having meeting with many hundreds of new launches across the liquidity spectrum, making sure that every one of those is visible to our clients.
And we're very grateful to Dr. John for the non-rated, because Dr. John was like an emperor. He would go like this or like this or like that, and then make or break GPs. So the non-rated option is a really good one. I'd complement what John is saying on investment and operational diligence with a third leg that we use as stable. So the framework we have for assessing founders is investment, operational, and commercial. And I'll touch on commercial in a second, but maybe just to break down the three functions, the things you need to be thinking about as an investor or as a founder on the investment side is really three things. One is, are you ready to go from employee to founder? So Enrico is touching on this as well. When you're at a big firm, 90% of your time is spent investing. And when you start your own, it goes down to like 40. So what we do at Stable is we try and give you lots of resources to increase the bandwidth on your investment side, take the distractions away, but really analyzing, are you able to make that jump and evolution? Because there's a lot of skill sets as a leader, hiring and firing, building trust with LPs that you have to be comfortable in, and as an investor you have to assess. The second one is sort of the person versus the seat. Once you leave a big firm, how much of your edge is behind you? Is it the brand? Is it the size? Is it the network? How much of that comes with you? Will it take X amount of time and Y amount of dollars to build? And just assess that, like how long is it going to take you to get that done? In operations, it's really about cost and complexity, so keep things really tight. People tend to empire build. It takes the rule of pi on time to raise money. So if you have to multiply everything by 3.14, and that's how long it's going to take, and costs multiply by pi as well. So put that in your budget and keep it low complexity. And then the third leg, that's a bit more the X factor, this commercial underwriting that we have at Stable, because as an interest in the firm, we want you to scale. There's three levels. There's the personal level. Are you a nice person? Are you likable? Are you trustworthy? Are you going to attract and retain talent? Then there's a strategy level. Is it actually differentiated? Is there someone that's bigger than you already doing it at half the cost? And then it's the peer group. So who are you competing against? Who's open right now? Where's that marginal dollar going? And if you kind of have answers for all of those things, I think you have a pretty good shot at making it.
Yeah, and I would echo a lot of what's been said by the other panelists. When I think about it, it boils down to, four things, the four Ps, people, process, performance, and partnership. And I'll just elaborate a little bit on the performance aspect. We don't require any sort of minimum track record length for emerging managers, but certainly a history of alpha generation is important, and we'll do the work to triangulate that through track record, reference calls, and so on. And I'll just add a few things that are maybe somewhat more unique to us. We also, we will focus on alpha, so we tend to look for managers with generally low beta or low market exposure. We also look for managers that can scale, as our group is already big and continuing to grow. And then finally, additivity as well. We have an established portfolio, so any new manager we bring forward, we want it to be additive in some form or another.
Okay, that makes sense. Again, I kind of sit in the same place that you do. I see people very early on. And one thing that we always try to talk to our clients about is the importance of having a strong non-investment team. And that doesn't mean that you have to go and hire everyone on day one, but you need to either be thinking about it or working with the outsourced providers who can help you think about it so that you are really looking at growing your business from an investment perspective and a non-investment perspective. And a lot of times the managers that don't make it are the ones that are not thinking clearly about the non-investment side. That you already have the investment side covered, you know you're good. But not having done, built out a business before or hired new employees or thought about who should be your CFO, COO, the list goes on, or CCO for that matter. Those are things that you really need to think about and take seriously. And the managers who tend to be the most successful, I find, are the ones that are thinking about that right from the jump. So I would echo the sentiments of everyone on this panel as well. I'm going to pivot for a second. Let's take a step back and talk about how your thinking or outlook has changed from last year to this year. Does anyone want to take that, Enrico?
Sure.
Richard?
Yeah, I think John touched on it earlier. I think we've seen a lot of competition for talent, and managers have a lot of opportunities and different types of opportunities to deploy their strategies now too. A couple of options that you could work directly for a multi-strat or a multi-PM platform. You could set up the manager could set up their own independent firm, but receive an allocation through an SMA from a platform. Or finally, there's a more traditional route, which is setting up your own independent firm and raising third-party capital. What the best fit is really depends on the individual manager there and their unique circumstances, their individual strategy, their scalability, their desire for independence, and even personal preferences as well, like location. I think where we differentiate a little bit, of course, we give the manager the opportunity to launch their own independent firm. We also come in with large investment size. We're looking to scale and form a long-term partnership. We're generally more tolerant of wider risk limits or drawdown limits, as long as believe they can generate long-term alpha. And we can support the operational side as well through some of our trusted third-party providers.
Yeah.
So, that's the
real
rise of
value add.
Talent. I think it also introduces opportunities as well. Platforms are a great incubator of talent. You see a lot of spin-outs, and when they do, they come out very experienced. And then secondly, I think we've stayed quite flexible on terms and possible partnership possibilities. And in some cases, we've successfully partnered with platforms, and in other cases, we've opted to be more selective.
Yeah.
I don't think there's a big change between last year and this year. One of the elements that we will look more, and that's across the board, is there any technological impact for innovation? Is any manager doing better at that and look into that and put into practice better than others? That's one thing. And the other thing is that when we do due diligence before and after investment, especially in the private assets, we have become much more focused on the quantitative side, also because we start having more transparency on that.
Maybe I just, yeah, I don't think there's a material change to our process, but I do think from a year ago to now, when you think about emerging managers, probably the single biggest shift is the fact that the private fund advisors rule was vacated. Yep. So, and so, you know, thanks to the MFA.
What do you think of that?
What's that, sorry?
What do you think about that?
Well, I think from a perspective of emerging managers, certainly I think it's now left a void, and so I want to make a plug for the SBAI, so the Standards Board of Alternative Investments, but also ILPA and other organizations that are filling that void with standards and best practices and standardization around investor reporting and other areas, which I do think for emerging managers launching, clearly compliance and regulatory oversight can create a cost burden for a smaller firm.
Absolutely.
But at the same time, there are benefits from actually kind of embracing industry standards that are supported by LPs and GPs. And so I think a year on now with the private advisors rule out of the way, many of the kind of provisions that were embedded within there about transparency of different aspects of their kind of fee transparency and other areas. There are great templates and different standards out there that I would just encourage any emerging manager and anyone working with emerging managers to try and get behind, because it actually makes it easier for emerging manager to flourish and engage with institutional investors if they do that. So
it's too bad because
totally
some of the go ahead.
No, totally agree. I think the GPs that we've scaled the most are the ones that have a leadership who believe that alignment with their LPs is better than necessarily eking out that last 10 bips of fees. I think one misunderstanding in the industry is that investors are going to give money to the people that are the best performing or the most intelligent. We haven't found that to be the case. Most of the money goes to the ones that are most aligned in terms of fees, transparency, governance, and just value the partnership. You heard Richard says one of his P's is partnership. Mm-hmm. That has huge strategic value. And like John says, if you're just running a business that the LP feels is aligned, you're going to be very successful. You don't have to be the best performer.
Yeah, I know we're pretty much out of time, but I think echoing that partnership point and what you're saying there, also, I think the best investors with emerging managers go in thinking about that long-term strategic partnership to have capacity down the line and not to cut fees early on. And Caroline made the point earlier, Caroline Cooley, just about that kind of the shape of fees and actually for smaller emerging managers, the best LPs in that space come in and pay full fees and really think about the working capital that's needed, but down the line get lower fees and or a guaranteed share of capacity, and that creates a long-term partnership.
Just to touch on what you were saying before with the vacation of the PFAR rule, it's too bad because some of the concepts that were built into that rule were sound concepts. They were reasonable and they made sense. But it's just the breadth at which that they were imposed upon the community was outrageous and just too much. But I think
there's only preferential terms, really. I think that's the only thing that basically torpedoed that rule. But yeah, in our opinion, based on our views of surveying dozens and dozens of clients, everyone got behind it except for that point. The large investors, don't want to disclose, their preferential terms, which is the
or offer them to everyone.
Yeah. So,
okay. Well, it looks like we're out of time. I didn't get a chance to ask all of my questions, but thank you all for being here, and thank you in the audience for listening. And hope you have a great conference.